Welcome back to Intermediate Accounting. This is chapter 16, and we're going to be talking about accounting for income taxes. You're probably like, wait, I'm in the wrong place. I thought this was financial accounting and not a tax class. And you would be correct. This is our only chapter that really digs into taxes, but it's not going to look anything like what you've seen in your other tax classes. We're not going to be filling out any kind of tax forms or anything like that. Instead, we're going to be focusing on how the differences in financial reporting and tax reporting affect accounting. So let's go ahead and jump right in. So our tax returns do differ significantly from our financial statements. The income statement is made to inform investors and creditors, while the tax return is made for the government to raise money and guide taxpayer behavior. That's why the numbers don't always match. So that's what we are going to focus on here. So first, we're going to be looking at temporary differences. So those temporary differences occur when pre-tax accounting income and taxable income are recognized in different periods. And this can take place with a lot of different transactions. They come from differences between the book value, which is what we're going to be calling the financial statements, and the tax basis, which is what we're talking about with our tax records, of our assets and our liabilities. The differences originate in one period and then later reverse in another, or maybe several other periods. So a short example, just to kind of introduce you to this: if a business records depreciation expense one way for its financial statements to spread it across evenly with straight line depreciation, but uses a faster method for tax purposes in order to lower your taxable income early on, then our accounting and income and taxable income are different in those early years. Later on, the differences reverse as the tax depreciation slows down. So you know that this is legal. We're allowed to use one depreciation method for our financial reporting and a different depreciation method for tax reporting. And this is the case with a few different things. And then there's other, methods that we are using according to GAAP. But then for tax purposes, they say, no, that is not how we are going to recognize revenue and expenses. So we're going to focus on those and look at how they are recorded differently and then how they reverse out. So first, let's focus on a deferred tax liability. So we have a new liability account. What an exciting morning or afternoon this is. It's morning for me recording this. A future tax payment a company expects to make is what a deferred tax liability is. So maybe we're getting a lower tax amount that we have to pay now, but we'll have to pay more in taxes later. So what happens when taxable income is lower than accounting income today is when a tax liability arises. So it's caused by these temporary differences, and depreciation being faster for tax purposes than it is for accounting purposes is one example of that. So for tax purposes, we are showing that we have, even less in income. So we're getting that benefit today. So we are depreciating our asset faster. And we say, we're going to pay less in taxes this year because we're depreciating it faster for our tax purposes. But that means in later years, we'll have to pay more in taxes. So that's where we are deferring our taxes till later. So it makes it a liability. So it's not a permanent difference. The tax will be paid later when the timing reverses. Then we have deferred tax assets. This video, we're going to be focused on the liabilities, but then we'll focus on the assets in a future video. But with a deferred tax asset, it is a future tax benefit. So we're paying more in taxes now, but then we get a benefit later on. So the taxable income is higher than the accounting income. So we're like, oh man, we have to pay extra in taxes this year because of this difference. But in the future, we will get a tax asset, we'll pay less. This is caused by those temporary differences, and a common one would be warranty expense. We record it now in accounting, but For tax purposes, they're like, no, you don't get to do a warranty expense before they've actually exercised their warranty. That's how we do it in GAAP. We say, okay, we're going to go ahead and record the warranty expense, and then we're going to have that liability sitting there, knowing that at some point our customers are going to come back and they're going to exercise the warranty. For tax purposes, they're like, no way, you don't get to make an estimate as to when the warranty is going to come through. Instead, you have to go ahead and pay taxes on that money now. When they exercise the warranty and you have those expenses, then you can deduct that and your taxes will be lower later on. Again, it's not a permanent difference, it's just temporary and it will reverse out later. So, tax expense it includes tax payable and changes in deferred tax assets and the liabilities. So we're going to see how tax expense is calculated when we have differences for financial and tax purposes. So tax expense, you're going to see this, it is a plug figure. It balances the journal entry after the accounting for tax payable and changes in deferred tax asset and liabilities. So we're going to be plugging in the tax expense. Most of the times we could also calculate it outside of plugging it in, but there will be some times that we can't do that. So we want to get used to plugging the tax expense in last. So let's jump into our examples, and we are going to start out with a new case study for chapter 16. And this is one of my favorite things. It's all about sugar. It's sugar rush confections. So all of our examples are going to have to do with sugar, some kind of dessert. So let's go ahead and start talking about a tax liability. And this is going to be with an installment loan. So Sugar Rush Confections reported pre-tax accounting income in 2026, 27, and 28 of $100 million each year, plus an additional in 2026 income of $50 million from installment sales of a giant candy sculpture. However, the installment sales income is reported on the tax return when it's collected in 2027 and 28. So 20 million in 2027, 30 million in 2028. The enacted tax rate is 30% each year. So what we have going on here is we've got 2026, they're showing 100 million plus 50 million from the installment sales. Now, this little chart that you're seeing, we are going to see over and over again throughout this chapter. So make sure that this is making sense for you. So you see 2026 pre-accounting income is 150 million. The 100 here plus the 50 million from installment sales. So the way that it works under GAAP is that we get to go ahead and show that revenue whenever we sold this giant candy sculpture, right? We did our side of the deal. We delivered that candy sculpture. For tax purposes, they say, no, don't pay taxes on that 50 million yet. You haven't even received it yet. Wait until you receive the cash. So in 2027, when they get 20 million, we saw that here and it's plugging in here. And in 2028, when they get the 30 million, that's when we're going to record it for tax purposes. So for 2026, we take our 150 of pre-tax accounting income. This is what we see on our books. We subtract out the 50 million for installments that we actually haven't received yet, and that tells us our taxable income is 100 million. Then when we jump to 2027, we say we made 100 million, but we have to add in the 20 million we got from that sale back in 2026. So their taxable income in 2027 is 120 million, which is 20 million more than they were showing on their income statement. Then in 2028, they also have 100 million and they're not showing anything for the installment. But for tax purposes, they say you got 30 million. This is when you need to pay taxes on it. So for tax purposes, they're going to pay they're going to pay taxes on the 130 million. So while for our income statement, it's showing that we have extra income in 2026 from delivering that candy sculpture, tax purposes, they say, no, wait until you actually get the cash. So in 2026, we're like, sweet, even though we made 150, sweet, you get it? I wasn't even intending on making that pun. So we're like, even though we made 150 million, they're only making us pay taxes on 100 million. but that creates a deferred tax liability because now in 2027 and 2028, our taxable income will be higher than our book income, than our financial reporting. So let's look at how this is calculated. So we go back here at 2026, we're going to focus on that. So we are showing 150 million on our income statement. But for tax purposes, they say take that 50 million off there. You haven't even made the cash from it yet. So then we have taxable income of 100 million. The tax rate is 30%, so we have 30 million that we have to pay in taxes. So that then pushes off the 50 million to the next couple of years, 20 and 2027, 30 and 28. So total, this is pushing off the 50 million to pay in a future period, future periods. We multiply that 50 that we're pushing off till later times the 30% tax rate, and that tells us we're going to owe 15 million in taxes later down the line when we collect the cash. So the 15 million is what we need to use to create our deferred tax liability. So remember, even though we are going to be paying taxes on the 50 million in the future, we're not paying 50 million in taxes. So we don't have a liability of 50 million. It's only based on that tax rate of 30%. So we have 15 million that we're expecting to pay in the future. So if we started our deferred tax liability with a zero balance, we add the 15 to it. So now we see on our balance sheet that there is a deferred tax liability, and it's related to this installment sale. So for 2026, the entry that we make, there's going to be these three accounts on all of these entries with deferred tax liability, and you'll see it here. Then we'll look at how it reverses out in the next 2 years. So our income tax payable comes from the $30 that we calculate, the 30 million that we calculated up here, and that's how much we're actually going to have to pay for this year's taxes. So that's really important. Income tax payable is the actual amount that we will pay the government for this year. Then we have our deferred tax liability. We have to create that with a credit of 15 million, and then we plug in the income tax expense of 45 million. Now, in this case, and in a lot of the cases, you can also check this plug number by taking the pre-tax accounting income times the tax rate, the 30%, and that would give you 45 as well. And so, yes, on your income statement, you'd show 150 million in income before taxes. Then you would show income tax expense of 45, which directly correlates with that 150 at 30%. Then you would show net income after taxes of the net amount of that, which would be 105. All right, hopefully all that made sense. Let's move on to 2026 and 27 and 28, where these reverse out. Okay, so now we are in 2027 and we're looking at our deferred tax liability that's sitting there at 15 million. But now it's time to record the 2027 numbers. Now remember, for the income statement purposes, they are showing $100 million. But then for tax purposes, they're going to be showing 120 million because they collected 20 million of the installment payment. So if we take that extra 20 million and we multiply it times the 30%, we get 6. So the 6 here is going to be leaving the deferred tax liability because this was an amount that we were pushing off till later, and now we're actually paying it. So we're going to decrease the liability by that amount, but then it's going to be reflected in the income tax payable. So the income tax payable is going to be based on the 121 million. So the 100 million from our pre-tax plus the 20 million they collected from the prior installment. So when we take 120 million times the 30%, we get 36. Then we plug in the income tax expense. Remember that income tax expense is a plug, but if we were to take the 100 million from the pre-tax income times 30%, we're able to check it, and it also comes to 30 million. That won't always work that way, but it does when it's just one temporary change. So we record that for 2027. Then going into 2028, we now have the deferred tax liability of 9 million, and since they're collecting the other 30 million, we take 30 million times 30%, and there's our 9 million. So now let's get that out of there because it's not a liability anymore. They are now going to be paying it. So we take it out of deferred tax liability, and we're done with that liability account for this installment. So then for our income tax payable, we take our total taxable income of 130, the 100 million from pre-tax plus the 3 million from the installment, times the 30%, and we get 39. And then our plug figure for our income tax expense, this is the amount that will show up on the income statement, is the 30 million. So now we've gotten rid of our deferred tax liability. It was great in 2026. We had less in taxes than we would have expected based on our income statement. But then in 2027 and 2028, we had to make up for it. Hopefully that money that we had to pay, we were able to earn some interest on in the meantime. All right, so now let's just look at depreciation expense and how this affects our temporary differences. And then that's all we'll do for this video. Then we'll be jumping into even more and looking at deferred tax assets and permanent differences in the future videos for this chapter. So we got our same company, Sugar Rush Confections. They reported pre-tax accounting income again for $100 million in each year, but this time we don't have any installment payments. In 2026, Sugar Rush purchased a donut-shaped oven capable of creating a large variety of themed desserts. The cost was $90 million. Wow. This fixed asset is depreciated for financial reporting purposes over 3 years on a straight line basis. Yes, we love straight line, and no salvage or residual value. So remember, no value at the end to be able to sell it. For tax purposes, the asset's depreciation is recorded as follows. So they're doing it differently for tax purposes. In 2026, they're recording 50 million, 25 million in 27, and in 2028, they're recording 15 million. So it'll be the same amount. It's the whole 90 million they're depreciating. They're just doing it at a different rate. And then they have their 30% tax. So same kind of chart we saw here. But this time we're going to see it that we're adding back the depreciation. So we had 90 million, straight line over 3 years would be 30 million each year. So we are first going to add that 30 million back into our net income. So we'll get back up to 130 million each of those 3 years. Then we subtract out the amount that we're going to be depreciating for tax purposes. Or maybe in your head you say, no, I'm just going to net this out to the difference. That's fine too. So now we have the 50 million taken out for depreciation instead of the 30 million. So our taxable income for 2026 is now just 80 million. But then in 2027, it's going to be 105 million because they didn't depreciate quite as much in 2027 as they did for our accounting purposes, for our financial reporting. Then in 2028, for tax purposes, they did half as much as we did for our financial reporting. So we're going to now have 115 million that's taxed. I suggest you take a picture of this as we go on to the next slides so you can follow along. So either way, they depreciated all 90 million in 3 years, but they did it straight line for their book, and they did it in an accelerated method for taxes. So this is going to create a deferred tax liability. They got a benefit in 2026, but then they had to pay more in 27 and 28. So when we look at 2026, the difference was 20 million. They took an extra 20 million in depreciation for tax purposes, which left them with taxable income of just $80 million. We multiply that times the 30%, and their taxes, our tax payable, will be 24 million. We're pushing off the other 20 million, or we're pushing off that 20 million until a future time. That 20 million times 30% gives us $6, which would be, or 6 million, which would be our deferred tax liability. So when it comes to our journal entry, just like we did before, our deferred tax or our income tax payable is going to be based on that 80 million that is taxable times 30%. So it's that 24 that we calculated above. Then the 6 million is put into the deferred tax liability. We're getting a break on that now, but we'll have to pay it later. Then we add those two together to get our income tax expense of $30 million. Now let's look at how it affects 2027 and 2028. So for 2027, now we are adding in an extra $5 million because they didn't depreciate as much in 27 for tax purposes as they did for their book purposes. So we're going to be taxed on $105 million at 30%. So their income tax payable will be that $3150. That leaves $15 million to be deferred till later. We're not going to have to pay all $15 million, just 30% of it. So that leaves us with $4.5 million that we'll have to pay in the future. The difference between the 6 and the 4.5 is 1.5. There we go. I was like, it's going to fill in at some point. So that 1.5 million is going to be decreasing our deferred tax liability, but we're going to see that reflected in our income tax payable that we're actually sending to the government. And then when we look at our plug figure, again, it's 30 million, which you could also take the pre-tax income of 100 million times 30%. And you see in this case, that works out as well. Then for 2028, we just move right along. They're going to have to add in 15 million because we took that extra depreciation in 2026. So now we have nothing left that we're going to be pushing off to later. So that whole 4.5 million is going to need to be depreciated in 2028. Not depreciated, but expensed out and paid in 2028. So we are going to see that 4.5 debited for deferred tax liabilities, and then we are going to see the 34.5 based on the taxable income for 2028, and then our plug figure again is 30 million. So we see in both of these examples, the installment and the depreciation expense, they were able to get a tax benefit up front, but that pushed off taxes until later, which created a deferred tax liability. You know, we do the same thing with a traditional IRA. That's our traditional individual retirement account. We're able to pay less in taxes in the year that we contribute to that account. But then later down the line, we'll be paying taxes on that. So we're really creating a deferred tax liability for ourselves as well. So hopefully all that made sense. Make sure you watch the future videos because we'll cover the rest of the differences between accounting and for financial reporting and accounting for tax reporting.